Hello traders, James Stanley with StoneX and Forex.com. For the past 3 months, U.S. equities have largely been stalled, and this has led to a growing sense of disconcern that maybe we're nearing a deeper pullback kind of scenario. I think there's an increasing rationale for being cautious in looking for those pullbacks. But with that said, we may also be in an environment where the positioning behind the matter is setting up for a sell-off kind of scenario. That said, I think if we do see a sell-off or a pullback, that makes more attractive the longer-term bullish backdrop in equities. And I want to use this video to explain why I think stocks have stalled, where I think they become attractive again, and why I think we could be looking at a deeper pullback type of setup in the not-too-distant future. So let's get to the chart and start diagramming some strategy. So first and foremost, I want to make this statement right up front where I don't believe that fundamentals are a perfect push point for price. I think fundamentals help to shape the future. I think technicals help to explain the past. That's what allows me to take strategy or institute if-then statements. But the only thing that is a perfect push point for price is buying and selling, supply and demand. That's exactly why I think this thing has stalled out over the last 3 months. And this is something we've covered in educational videos on this channel over the past few weeks in talking about psychological levels. We can see right here, the 7K level in the S&P 500 and the cash index has become like a brick wall for bulls. It even started to play out here back in October, right around the Federal Reserve's rate decision on October 29th. At that point, we were less than 100 points away from the 7K level, but that's where Jerome Powell started to indicate that the Fed might not be completely on board with a December rate cut. The reaction was brutal because you could see that we had this strong bullish trend leading into that rate decision, and that shock factor was enough for a crowded trade to show into a near-term crowded exit. Now, it didn't last long because ultimately data started to stack up that suggested that the Fed would in fact cut rates. That's where the proverbial rubber hits the road. I think fundamentals can oftentimes induce supply and demand. And that's why I think many will often make the relationship that fundamentals drive price. But the reality is there's a conduit between the two. Supply and demand, buying and selling, market participants. I think in many cases, if a market is in balance, then fundamentals can have a direct push point on price, where positive data equals a bullish response, negative data, a bearish response. But when we get what we've had in the S&P 500, where markets are up, this is up 45%, just about 45%, currently about 42% from the April lows last year. So in like 10 months, it's up 42%. Logically speaking, there is imbalance in here. Now, it's not to say that the move can't continue, because as we've seen in markets like Bitcoin a few years ago or the current rally in gold, an overbought market could get more overbought. Or as Graham said, markets can remain irrational far longer than anyone can remain solvent. Well, from a balance perspective, I think what would need to happen to bring even more bulls into this would be so over the top that the odds are somewhat stacked against it. And that's why I think the reaction that we saw back in October made sense. The Fed just pushing back a little bit on the idea of a December rate cut was enough to compel a sizable pullback. And then ultimately we did get that rate cut. We didn't even take out the prior high until we got into late 2025 trade, until we had the Santa rally that drove to a fresh ATH. But now we have the 7K level. And you have all of those longs that have been loading behind the bid for the past 10 months. And as this stalls around that 7K level, even with those rampant expectations for the Fed to cut more this year, there's been an increasing rationale for longs to take profits. So I think one easy way of presenting a crowded trade is if anybody and everybody that wants to be long already is, then there's nobody on the sidelines to push fresh demand. And that's what can lead to a situation similar to what happened last year, where the right combination of a surprise in the headlines with an overbought market can lead to one of those crowded exit kind of scenarios. So this isn't something where I think the past is going to predict something new in the future, because we're just simply looking at technical analysis. We're looking at the fact that this move has been stalled by and large for the past 3 months. And then we can make the assertion that some of these longs probably need to get stopped out to put more capital on the sidelines to get us a deeper pullback before the bullish side of the setup is ready to go. Now, a couple of levels that I've been following pretty closely in forecasts for the past couple of years derive from this major move. It's the 2022 pullback, and it's the Fibonacci extensions off of that pullback. Now, you'll notice these test out very well. The 618 extension, this is what held the high in July of 2024. That's when the Japanese yen carry trade began to unwind, and we had a brutal 4 weeks, even worse or more brutal, in the Nasdaq 100 as we saw those high-flying tech stocks get taken out aggressively. This morning of August 5th was the third highest spike in the VIX index ever. And that's essentially a rate of change type of argument. So we could see how quickly that came on after that one-sided trade unwound. But moving on, the 100% measured move of that 2022 pullback plots right here. This is what held the highs last February, right around 61.45. The 2.272 extension, this caught the highs back in August, and so far has remained pretty well defended. Now, you'll notice that's right at 65.06, so that's confluent with another psychological level with 6,500. Current support at 6,800 has been well defended, but the problem is that bulls are letting it slip a little bit more with each recurrent test, indicating that eventually that next test, one of these next tests of 6,800, may not bring in buying demand. You'll also notice we've had lower highs as bulls were even unwilling to retest that 7K level after we had that instance in late January. Now, when we take a step back and look at the weekly, I think ideally it's that 6,500 level to sticks out of support. And then perhaps more than that, 61.45. Because you'll notice that did almost a perfect job of setting the highs in February of last year and hasn't yet been retested for support. The thing is, if we get a test down to 61.45, I think the headlines are going to go manic. And I think we're going to have a panic, kind of euphoric panic as we see that theme develop, if we see that theme develop. So I want to hold out expectation for a move that deep. Instead, I want to keep it relatively light, looking at that 6,500-ish area that was prior resistance back in August, has so far been defended, hasn't quite come back into play. You'll notice we got really close, just like, was that about 19 points away from that swing low in November, that swing low that developed very quickly after the FOMC rate decision. And I think there's a growing backdrop that could produce something like that. As we've been hearing more and more from Fed members, we might be at the neutral rate already. There might not be huge demand for more rate cuts, especially if, as we saw in the NFP report most recently, the labor market in the U.S. isn't looking all that bad. So there could be a growing backdrop of fundamentals that could support a deeper pullback. But ultimately, it's this trade being so crowded that I think has prevented it from leaving behind that 7K level. And that's reason to be, I think, maybe a little bit more cautiously optimistic for a larger pullback. That 6,500 level just really stands out. Now, that said, I always like to go into these scenarios with a few different possible outcomes. I don't want to hang my hat on looking for a 6,500 retest because maybe we don't get it. Instead, I want to get kind of a central level in here. And you'll notice we had this swing high that developed right around 6,700. Again, that's a psychological level. And that was defended right in here, like 67.20. That gives me about a 20-point zone below current support. That's what I'm going to look to as like an S1 type of level. All right, if we get price to come down in there and find some buying support, if I could get some underside wicks on the daily chart, then there's a swing trade in there. I could work off of that. If that doesn't hold, no big deal. I simply cast the gaze down to 6,500. If that doesn't hold, then we're dealing with something else entirely, and that 61.45 becomes the next major spot that I'm looking at. And I get it. It's difficult to imagine that outcome happening right now, which is why we want to plan for a few different scenarios. But if you take a step back and you look at what developed last February, there was a similar sense of maybe disbelief as we saw that sell-off beginning to develop. And it happened very quickly, but paradoxically, the most attractive time to get long in equities is when you have that deep oversold reading that begins to show on the daily, and in this case, it even showed on the weekly chart. But it's when much of the market seems scared that it's time to start being a bit more greedy. I want to look at a couple of additional indexes as I think there's something that we could pull off of NQ and the Russell 2000. In NQ, similar story where we had this very profound rally that set a high on October 29th. In the Nasdaq's case and Nasdaq and NQ futures case, it hasn't been able to take out that prior ATH. We have had a grinding range so far, but the fact that we've seen trepidation at taking out those highs, that there has been a degree of lag. I think this further goes to illustrate that there should or could be a lean towards a deeper pullback type of setup or scenario. That said, it's this level around 24K that so far has been well supported. We saw that in November after the October 29th high, but a retest at that level, I think, is still open for a bounce, but ultimately, I think the level or the area that's a bit more attractive for that is right down in here where we had this swing high from December 2024 that syncs up to like around the 38.2 of the recent major move. Again, a bit deeper, it's down around 22.5, but high-flying tech stocks have very much been in a state of pause over the past few months. And, the rally here from the April lows was just profound, 60.38%. So, again, logically, this is still a crowded trade because we've seen very little rotation out of this. We've had the simple pullback that so far has been bid. There's still a lot of longs that are holding on here. If we break below some of those supports, the selling pressure could be pretty severe. That said, the index that might be most attractive now on the long side is surprisingly the Russell 2000. Coming into the year, Russ was somewhat of the outlier. I mean, let's actually go back to like that October 29th rate decision. Russ was somewhat of the outlier in that it had just started to make a fresh ATH above this 2,500 level. 2,500, or technically just inside of 2,500, held over a couple of different instances. But we finally started to wiggle through that late last year, the pullback of which then propelled up to a fresh high. This is the one index that has really shown some signs of rally so far in 2026. So surprisingly, this one might be a little bit more attractive if looking to push long bullish U.S. equity thesis. But that said, we are seeing a similar sense of stall of late around the 272 extension of that 2024 to 2025 pullback. But very clearly, I think there are three levels of note. So if we don't get a deeper pullback type of setup, I think this zone right in here, constituting S3 from 2460, the prior high, up to around 2500. I think that's a pretty attractive area to look for support to come into play. I'm looking at S2 at like 2560, and then S3 at around S1 around 2605. Go down to the daily. It's a little bit more sharp, but I'm looking this or construing this as more of a symmetrical triangle, which, when combined with the bullish trend or the bullish rally, makes for a bull pennant formation. And that is very similar to what we had seen play out in gold on a bigger picture basis. But that, my friends, is what I have in U.S. equities. I still like the long side. Still think that we have an open door for a melt-up scenario at some point later on this year. But given the sense of stall that we've been seeing, I think we've got to open up for deeper pullbacks, especially in the Nasdaq, especially in the S&P 500 and the Russell 2000. It's been impressive so far in 2026. But as usual, thank you for your time and happy trading, ladies and gentlemen.